Why I ignored the dot-com boom. There was a period when just about everybody around me seemed to be getting rich faster than I was. You'd turn on the television and see people talking about a new era. You'd open a paper and read about businesses with no real earnings being valued as though they had already conquered the world. People who had never looked at a balance sheet in their lives were suddenly experts in technology, growth, and the future of commerce. And if you were sitting there doing nothing or close to nothing, you looked foolish. That's the part people forget. It's easy to say now that a bubble was obvious. It never feels obvious when you're inside it. Inside it, it feels like you're the one being left behind. Inside it, caution looks like ignorance. Discipline looks like fear. And saying I don't know sounds like weakness when everyone else seems to know exactly what's going to happen next. But investing has a way of punishing people who need to feel intelligent in public. One of the most important ideas in investing is very simple. You do not have to understand everything. You only have to understand a few things very well. The trouble is, most people cannot tolerate that. They want to have an opinion on every industry, every market, every trend. They want to participate in whatever is rising. They want to feel current. Charlie and I never felt any obligation to do that. We never thought our job was to swing at every pitch. Our job was to wait for the few pitches that came into our zone and then act decisively when the odds were clearly in our favor. During the technology boom, most of those pitches were not in our zone. That didn't mean the businesses were bad. It didn't mean technology wasn't changing the world. It didn't mean smart people couldn't make money in that area. It simply meant we were being asked to value businesses we did not understand well enough in an environment where prices were being set by enthusiasm rather than economics. That's a very dangerous combination. You can get away with a lot in markets for a while. You can pay too much. You can ignore competition. You can pretend valuation no longer matters. You can tell yourself that old rules are obsolete because the world is moving faster. What you cannot do forever is suspend arithmetic. At some point, what a business earns has to matter. At some point, what you paid for it has to matter. At some point, enthusiasm has to meet reality. And when that happens, the investor who paid any price for a popular story discovers that growth alone is not enough. A wonderful future can still be a terrible investment if you paid too much to participate in it. That was really the issue. People sometimes say, "Why didn't you just buy the good technology companies?" And that question sounds very reasonable after the fact. But you have to remember what the environment felt like at the time. It wasn't a quiet market presenting a few attractively priced opportunities. It was a crowd rushing into anything associated with a certain idea of the future, and prices were rising because they were rising. That isn't investing. That's social proof with a ticker symbol attached to it. If you let the crowd do your thinking for you, sooner or later, you'll pay the crowd's price. And the crowd rarely offers a bargain. What made that period difficult wasn't that we lacked intelligence. It was that we had to be willing to look wrong. And that is one of the hardest things in investing. It's not hard to be disciplined when discipline is being rewarded immediately. It's hard to be disciplined when every signal around you says you're missing out. People were making money very quickly. Friends of friends were talking about stocks they had bought on little more than a rumor and a rising chart. Financial commentators were suddenly using language that made caution sound outdated. If you weren't participating, you could feel irrelevant. That emotional pressure is more dangerous than most balance sheet risk, because once you begin investing to avoid feeling left out, you are no longer allocating capital rationally. You are using money to medicate insecurity, and money does not perform well under those conditions. One of the great advantages in life is being able to say, "This is outside my circle of competence," and then sit still. You don't get bonus points for having an opinion on everything. In fact, Having an opinion on too many things usually costs people money. The circle of competence idea is often misunderstood. People hear it and think it means limiting yourself. It doesn't. It means knowing where your edge ends. It means understanding that there are many intelligent people in the world, and some of them understand things you do not. It means respecting that fact rather than fighting it. The world will always produce exciting stories. It will always produce industries that seem to be changing everything. It will always produce industries that seem to be changing everything. It will always produce periods where the people being careful look old-fashioned. If you cannot tolerate those periods, you will overpay. And if you overpay often enough, even good businesses will give you bad results. That's what the dot-com period really taught. It wasn't just a lesson about technology, it was a lesson about temperament. It was a lesson about the social cost of discipline. It was a lesson in how uncomfortable patience can become when speculation is making your neighbors look brilliant. Most people assume the hard part of investing is figuring out what to buy. Very often the hard part is deciding what not to buy, and then living with that decision while others appear to be winning. That period also reinforced something else Charlie and I always believed. The market does not grade you every quarter on whether you looked smart. It grades you over the long run on whether your capital survived and compounded. There are times when doing nothing is not inaction, it is a decision, a serious one. At Berkshire, there have been many occasions where people expected us to do something simply because cash was building, or because markets were moving, or because opportunities seemed to be everywhere. But activity is not the objective. Results are. An activity undertaken for its own sake is usually expensive. When the world becomes excited, investors begin lowering standards without admitting it. They stop asking what a business is worth and start asking how high it can go. They stop asking what could go wrong and start assuming that recent momentum is proof of permanent quality. They stop requiring margin of safety because they've convinced themselves that certainty exists. It doesn't. There is no certainty in investing. There are only probabilities, and when prices get detached from reasonable expectations, the probabilities become less attractive, no matter how popular the story is. That's why discipline has to be internal. It cannot depend on applause. It cannot depend on looking right in the short term. It has to come from having a framework that you trust more than the crowd. If you need external validation to hold your ground, markets will break you. The lesson for an ordinary investor is not that technology should be avoided or that fast-growing industries are automatically dangerous. The lesson is that you must know what you understand, know what you do not, and never let envy push you across that line. If a business is outside your circle, pass. If the price requires heroic assumptions, pass. If everyone around you is making money and you feel foolish for being careful, that may be exactly when caution matters most. It's not your job to participate in every boom. It's your job to survive them. And over time, survival matters more than brilliance. The investor who keeps capital intact, waits for opportunities he understands, and is willing to look wrong for a while will usually end up in a far better position than the investor who needs constant action and social confirmation. That's what ignoring the dot-com boom was really about. Not fear, not stubbornness, not missing the future. It was simply a refusal to abandon discipline in order to join a crowd that was being rewarded for a while. In investing, for a while can be a very dangerous phrase, because eventually the arithmetic returns. And when it does, the investor who stayed within his circle, demanded value, and remained patient will still be standing. That is a good place to be.